talk to you about, well, I think the topic is called Do the Maths. And I think the main thing I want to sort of, in fact, let me just go to the contents page of the agenda. So what I'm thinking about for this session is just setting the scene for where you are in your current stage of your entrepreneurial journey. And then I'm going to go through some key headlines about what I think you should be thinking about just before you embark on your path of setting up a company or looking at fundraising. And I'll also talk to you about some tax relief. And I'm just rewinding back. So I think this is a 3-part series. So we've tried to structure it so that we're kind of containing different sections of how to grow your business in 3 different sections. So first session will be about company setup, EIS and R&D, and then the other 2 will be more developing that further and understanding how do you deal with your accounts, how do you deal with the company's house matters, how do you deal with the VAT, how do you deal with other tax relief that you can help you as you develop your business. So that's the sort of basis of these 3 sessions. So hopefully you can join me in that over the next few weeks. And I just got a disclaimer here to say that just, always take professional advice before you sort of take the plunge, just in case you may find that there's a better way of doing it. But again, this session is also helping you understand and educate yourself before you do certain things when it comes to accounting and tax. So I think just quickly a bit about me. I run a company called Telic, which is a purpose-driven, we focus on purpose-driven entrepreneurs, companies who are making an impact, companies who are trying to make a difference, but also limited companies or trying to generate growth, but also making an impact. Ex-alumni from LSE, ex-PwC, and got the various qualifications from the accounting bodies and tax bodies, and keen runner, cyclist, and got 2 children. So that's just a bit about me. Now, just getting into it, before we start, feel free to ask questions through the session. LJ, I can't see the message board given I've shared my screen. So if anything pops up and I haven't picked it up for a while,
I've got my beady eyes on it, don't worry at all.
Fantastic. And again, please just shout as well. And I think we've got quite a small number here. So it's great to kind of use this session as interactive as possible. Do just shout out if you think you've got a relevant question during the particular slide, rather than waiting till the end. Because if I find that this question is slightly too off-piece or technical, I may just pick that up afterwards or at a later on or after the session. So again, just trusting again, please try and make it interactive as possible. Right, so I think I've got these 3 images here just to get a feel for you're about to start your entrepreneurial journey. And I've got a clock here to flag that you don't need to jump into setting up a company straight away. That's something I want to just flag as a key takeaway for you as startup entrepreneurs. And the last picture is about the government, how utilize what the government have given in terms of tax relief and incentives to get your business up and running. So I think that's a sort of general theme of today's session. Now, maybe I just get a sort of raise of a hand or a question just to check. Has anyone set up their company yet? Was anyone about to set up their company? If anyone's willing to share that information.
I haven't incorporated it. It's been almost a year now.
Okay, so you've been operating for a year, right?
Yeah.
Okay, correct. Great. So you've got a company set up and you're operating. Okay, great. So this may not apply to you because you've already set your company up, but some of the director loans and some of the other points we'll pick up on, but it's still good to understand how business structures work. So there's 3 main structures to think about before you embark on setting up a business. The first one, which is literally, you can think of a market stall. You go to a market stall, I know at the moment it's all closed, but if you were to go to say, a car park, put up a shelf and just start selling things, that's a bit like there's no legal framework between you and the business. It's very much you are the business. You as an individual are selling things in the marketplace. You're out there generating revenue. So that's basically a sole trader, sole participator. And how that works is very much you are the entity that's selling it. And there's no separation between you and the business compared to a business or a company, which I'll come on to. Then there's a partnership, which is very similar to a sole trader or a sole proprietor. And how that works is when there's more than one of you. So I think, Alice, you have a co-founder, if I remember, because I've spoken to, I believe, yeah, that's right. I think I didn't speak to you. Yeah, I've spoken to your colleague, and so your co-founder. And you could argue, let's say you didn't have your company right now. Between you and your co-founder, you set up this business, this platform that you've generated, and let's say you had 4 clients that's come on board. So you, as individuals, have taken on these 4 clients as a partnership or as a sole trader if you're on your own. And how that works is that you will be taxed on that income on yourself. So you'd complete a tax return, you take on the invoices, the sales, minus the expenses. So it's very much sitting with you. And that's very different to a company whereby there's a separation between you and the business or the company. And that's quite important to understand. It's like having a wrapper. So you've decided you're setting up a business and everything you do will be inside that wrapper. So if you think about any big company like Marks and Spencer's, BP, Glaxo, they're all within a company. So everyone works within the company. All the directors are in that company. And above that sits the shareholders. So this is where, for example, and I'll talk to you about the life journey of a very early startup. And a lot of you guys are probably doing this right now, whereby you've got an idea, you're thinking about it, you're really building up knowledge, you're building up databases, you're building up, your contacts, and you're spending some money on it, but you haven't set up a company yet. Effectively, you're starting to establish your own sole trader business, and that's completely fine. And I'll come on to some tips about the pros and cons of this. But I just want to set the scene about how important it is to understand what you're doing as you start developing your idea and how the business structure works. So it may be easier if I just jump onto this slide, because this talks about the difference between what is a sole trader partnership limited and limited in terms of pros and cons. So let's take Alice, for example. So I'm going to use you because I think you raised your hand. Thank you so much. So you're in this category at the moment, but let's say you decided right last year that you wanted to just start straight into a sole trader, you are a partnership, you and your co-founder. So the good thing here is that there's no cost of setting up a company, which is quite cheap in some cases, generally anyway. But the minute you start up a company, you've got to start worrying about this statutory filing. So I'm sure, Alice, you're aware that at some point in the next few months, you will have to file a set of accounts. You will have to go to Companies House, an online system, and confirm that you've X number of shareholders. So there's a few sort of administrative things which normally you can either do it yourself or you get someone like myself or an accountant to get involved in. But the whole point is that what I'm trying to stress in today's call is that if, say, you're months away to starting up generating expense, or months away to have an invoice issued to a client, you don't need to set up a company straight away. And I found that with certain entrepreneurs, especially even when I was presenting to some LSE entrepreneurs a couple of years ago, when we're allowed to have physical lectures, they just said, oh, well, we just set up a company because we just thought that's the thing you got to do. So I just want to stress that you don't need to jump into set up a company just because you've got a great idea and you want to explore it. And what I would suggest you do, though, if you are going to set up a new business, keep a record of all the expenses that you may have incurred as part of that journey to build a business. Because even though you haven't set up your company yet, a lot of those costs we can start capturing in some shape or form, whether it's in your own personal tax return to reclaim that as an expense, or from a VAT perspective, when you start incorporating and you start generating revenue. So there's various reasons why I'm bringing this up. So again, I'll just come back to the slide. The only downside for having it so that at the moment, you can't really do anything with this. So as a sole trader perspective is you can't borrow, but at the moment, I probably think you probably may not borrow. You'll probably raise money through issuing shares. And again, there's no shares here. So this is where a limited company is a lot better. So let's say Alice, for example, she's now got a credible product that she wants to go out to market with. She's got traction and she wants to get investors. You can't raise money as a sole trader because people can't get a shareholding of what you are because you are the business. And that's the whole concept of having a limited company. There's a pure separation between the two. And that's very important to understand, not just from an accounting and tax perspective, but also from a legal perspective. I'm not sure whether you've had a session on this from a lawyer, but the main point to flag here is that a limited company is very much a separate body or separate, not a living being, but a separate thing that generates revenue, generates business decisions. And let's say it makes a bad business decision, then the client or the supplier or the contractor or the creditor, they can only go after the company rather than yourself. So I think, again, one of the negatives for a sole trader is if something goes wrong, or you give the wrong advice, say, or I mean, in some ways, a lot of the businesses that we deal with, they're platform based, or they're selling a product, so there's less risk of you being potentially sued for doing something wrong. Where let's say you're doing a medical business, where it's probably better to be in a limited company. But again, it's just something to flag that being a sole trader, there's slightly more legal risk if something were to go wrong and your client was to come back and potentially sue you for any sort of damages. Whereas limited company, there is that slight level of security there. But again, going back to more accounting and tax focused matters, let's say, I don't know whether we've got any post undergrads or individuals who have started working and are generating income for the last few years, but they've decided to stop working or reduce their working hours in employment, but now generate a new business. So I just want to stress here, if during, say, the tax year you generated losses, what's important is that you can offset some of those losses against your taxable income from your, say, employment income. So it's quite a powerful thing where, let's say, you're just not sure about, and I find this with a lot of entrepreneurs where they've got a good stable business, good stable employment right now, but they're dabbing their feet into a new idea, a new project, especially now during lockdown, whereby you may want to consider a new avenue of income. So rather than stopping your employment income, you can start building up time to, or even cost potentially in this new business. And what you can do is offset some of those losses against your employment income. So therefore you pay less tax. And the government are trying to say that if you are being an entrepreneur, you're trying to do something different, you can offset against your other taxable. It's like having two businesses. One is your employment income and one is your business through your sole trader partnership. And they're saying that they're all one thing. And so whatever the total profit or income is, you can then only pay tax on that. So it's quite handy. But the only downside is that your profits will be higher. Your taxable profits will be higher as a sole trader versus a company. I don't want to dwell too much on the sole trader side, because I expect most of you will be potentially being co-founders, or you'll be setting up a company relatively quickly so you can raise money. But again, in case you're not, I wanted to flag that there are big differences. And one of them is, as I mentioned to you, the losses. The other one is the lack of ability to borrow and raise finance. And I'll come on to that in later slides. So I think, is there any questions? Because I don't want to go into all the detail here, because there's quite a lot here, but I just want to give the key points in case this resonates with anyone. So Ajay, is there anything on the message board, or should I continue moving forward?
Yep, keep going. This is
okay.
Great stuff. Guys, feel free just to drop anything in the chat.
Yeah, and again, even just unmute yourself and just ask a question, because as I stressed before, it's quite a small group, so don't feel shy about raising some questions, because I'm sure it'll be relevant to everyone on the call. Okay, so I think just to kind of sum up that slide, because there's a lot on there, the key point is, why incur costs of setting up a company, to dealing with companies' accounts, dealing with corporation tax returns, and worrying about it straight away. Don't let the time tick straight away, because you obviously got a 1 year for accounting period. But then let's say you don't start generating sales for several months. Don't just start from day one setting up a company, because you may find that you'll end up in a year's time having to deal with a bit of the compliance for getting the account sorted, getting the bank reconciled. So there's all these sort of things which will need to be done once you set up a company. But regardless of when you set up a company, any costs you incur for your new business, new venture, do keep a record of receipts and payments, because they can be potentially offset from the losses, which I mentioned to you from employment income here, or we can potentially use them in the company in different ways. And I think one of the things I want to stress, which I find a lot when it comes to entrepreneurs who've just decided to quickly go online and spend, say, just a few pounds to set up a company. One of the things that people forget to consider are things called different share classes or alphabet shares. So again, I'm just going to, as a question, another question, just use Alice as an example. I haven't seen her company name or company's filings on Companies House, but let's say there's two founders and say they both own 50% each. So a lot of founders will just set up one share class and say 100 shares and we each own 50 each. But that may not be an option. There may be a better way of doing that, whereby you have two share classes, Class A, Class B, and they're both ordinary share classes, and each share class has 50 shares each, and each of the co-founders have one share class each, all the shares in each one of the share classes. So it's still the same shareholding percentage, but they own a different share class. And the reason why I bring that up is because what happens is, let's say in the future, one of you has a life event, whether they're getting married or they are they're going to buy a house, and you've got a lot of cash in the company and you want to try and take a dividend out. So the key point here is the other person may not want to take a dividend out, and that will incur quite a bit of tax on that individual for both parties to receive the dividend at the same time. So the reason why I've suggested another option is having two share classes is because if there is a requirement where one doesn't need the money and the other one does need the money, you can elect to only issue the dividends to one share class. So it's just something as a protection for future-proofing your cash flow and your taxable income between the co-founders. So it's just something to bear in mind. Oh, can anyone hear an echo? Or
Kevin, I'm just going to put you on mute because I think, there we go, that might be better.
Oh yeah, that's right.
Can I ask a question on this, Yogesh?
Of course, yeah.
So in terms of the different share classes, is it still something that can be changed after you have assigned two co-founders to the same group, to the same kind of shares? Can you still change it afterwards?
Yeah, good question. And people do always ask that for me when I mention this. And yes, you can. And the thing with anything with lawyers is that it's a bit more hard, it's slightly a bit more work and changing formal articles. So they'll need to add an article, they need to update new articles into Companies House. So to answer your question is yes, and you'll have to just tell your lawyer or get a lawyer to just add a share class and make that change. Because from a tax perspective, you're not changing any ownership. You're not creating any value shifting or anything like that. All you're doing is going from one share class, you're duplicating it, and you're just splitting the shares accordingly. So the quick answer is yes, but you may just incur some legal costs to do that. And this is why I always tell clients, whereby get it done at the start. So even if you never use it in the future, you'll always have that sort of fail-safe mechanism to future-proof yourself. Okay, right. So I think that was that on the common pitfalls. Any questions before I move on? Okay. Oh, I think I just saw, I can actually see the message board. I've just figured that out. Great. Do VCs like to see different share classes when they do due diligence? Very good question, Arthur. So I think the wider question you've got to ask is, they don't like complex, messy, or they don't like sort of complex share cap tables. But just because you've got a complex share cap table doesn't mean you're not a good business. If you've got a viable business and you've got great an idea and a great growth prospects, you can always change the share cap table in some shape or form. But in terms of the share classes, having one or two share classes, or even three, is not a complex thing, and it doesn't create too much of a sort of complex share class system. And what happens is, I've seen with certain clients I deal with, is where we may have 3 or 4 share classes, whereby you have 2 co-founders, A and B, and then you've got a third share class called share class C, which is for, say, investment round that they just done with the early investors, so EIS, SEIS shareholders, angel investors. And they've got a 4th share class, and that's for the employee share option pool. And I'll come on to this on another session, but you may want to reserve a share pool amount for key employees. So to answer your question, it sort of depends on how complex it is, but having a few for what I'm mentioning wouldn't create any sort of issue, from my understanding. I hope that answers the question. Okay, now I'm just going to move on. So just change this. Yeah, so I think what always comes up when I speak to early stage entrepreneurs is, how do you deal with me as an entrepreneur spending money in my business? So, because a lot of the things, what happens very often is that a director or co-founder, they've got their own funding. They want to bootstrap the business. They don't want to go out to market and raise money, because they'll have to dilute their shareholding. So the key here is that they want to spend their own money to further the business. So it could be as simple as Facebook ads, Google ads. Who's spending that money? And it's you as a director. So just to be clear here, everyone, I'm assuming now you've got a company. So let's just assume we've got, has anyone just set up their company by any chance? I can use a live example, or if there anyone who's about to set up their company and they want to just, have I heard a mic?
Hi Yogesh, Nakul this side. So yeah, I am about to set up my company pretty soon in the month of Feb itself.
Okay, great, fantastic. It's Nakul, right? Yeah, Nakul.
Yeah.
Great, Nakul. So, okay, so that question I'm going to use you as a live example. So, are you on your own, or you got co-founder?
So yeah, I also wanted to understand from you, like I have guys who are working with me, and I would consider them as a co-founder, but I am not sure what kind, the kind of a commitment these guys have is limited, and they are not on board, and they as the company is still a pre-revenue stage, so
yeah,
the kind of a commitment I'm getting from them is very limited.
Yeah.
So I wanted to understand what kind of shares or what kind of rights I give to them.
So that's a really good question, and I think I'll probably spend more time on that particular question on another session, which we've got I think it's probably on the second or third session I'll develop that. But what I want to flag is that for you is that there are things you can consider, like, as you mentioned, growth shares, or thinking about if they're going to be employees, or if they're going to be sort of very well invested in business, you may want to think about a hurdle share or EMI share option. So I think definitely there is scope there to consider different options. But I think for this level of this starter session, I want to sort of keep it relatively simple, but you can consider growth shares or EMI share options if they are going to be employees, and I'll be developing that further in the next sessions. So if you don't mind me build that up later on.
Sure.
But I will use your example still, Nakul, about you just set up a company. So let's say next week you've just set up your company. Is it called Crowd Bazaar?
Yeah.
Okay, great. So Crowd Bazaar Limited, and you at the moment are a 100% shareholder. So you've got, Nakul, 100% shareholder of Crowd Bazaar Limited. And you haven't even got a company yet, sorry, a business bank account yet, because it takes a few weeks or a few days to set up a bank account. So therefore, going back to the first slide, right now, you're in this category, right? So you create a separate legal entity which has its own legal rights and responsible for its own debts. And again, the key protection point here from a legal perspective is that any owner there's a separation between Nakul and the company now. But from a bank and a monies perspective, it's slightly different, because let's say, for example, Nakul now needs to spend £5,000 on the developers to develop his platform or business idea. So the company has zero money, sorry, not even a bank account, let alone zero money in the bank account. So let's say 2 days later, he needs to pay the developers so that they can get on with the work. So here's what happens. There's a director's loan that's created by Nakul to the company, because it's the company's cost. And that's a very important distinction I want to flag. And I'm just going to bring my next slides. I know there's a lot of words here, but hopefully you can just digest what I'm saying and then use the slide to just reinforce it. Effectively, what Nakul is doing, he is the term bootstrapping, which I'm sure many of you have heard. He is pushing himself with his own sweat and money, hopefully from his previous employment income or saved funds. He's got money right now, funds, to fund the business. So he still keeps 100% of his equity intact. He doesn't get a loan from a third-party bank or a fundraising platform. He just wants to get the business up and running, but he needs cash flow. He needs working capital. So he's funding it himself. So he's lending to the company. And I want to stress a few points just to debunk any myths that any sort of entrepreneurs feel they're worried about. The key point here is that your company, say Crowd Bazaar, does not have to pay any tax on the money it lends or it spends on behalf of the company. So even if you transfer the money directly to the developers, there'll be, in the accounting world, there'll be a director's loan going from you to the company, and it's effectively an IOU. I'm sure you can see my mouse hovering around, but it's an IOU to the company, and that's very important. And that you realize this and you keep a record. So let's say every week now, Nakul, you have to spend, say, £500 to keep your developers working on your project. So, and it's taking you a long time to get the bank account set up. So all that's happening in your Excel document you're going to keep of all your records of your expenses is that every week, £500 is going from your bank account into developers' bank account. And in the accounts, we're saying the company has got a director's loan. And I'm not going to go into this point here because you're going to create, you could charge interest on that loan, but I'm not going to go into that because that creates a lot of tax implications and paperwork. So that's more for bigger entities and when you've got a well-established SME, a small medium business, and we can think about different structuring options. But I just want to flag the key point is that when you lend to the company, you are effectively bootstrapping, you're doing an IOU, and eventually when the business generates revenue, rather than paying yourself a salary, just pay the money back to yourself. And that's the whole point of the tax treatment I want to just raise with everyone, whereby rather than paying yourself a salary, just the money you put in at the beginning as working capital, just pay it back. Because if you say, oh no, I want to pay myself a regular salary, when you pay yourself a regular salary above a certain limit, you'll have to start paying tax on that. And it's very important how you categorize that when you post the entries in your accounts. Because let's say you just put £10,000 salary rather than £10,000 IOU repayment, then in HMRC or the company's house perspective, that's a payment of salary rather than a payment down of your IOU. So it's just something to be aware of. And many of you probably know this if you've done an accounting and finance degree or you've done some sort of accounting related role before. But I just want to raise that as a awareness point. It's a simple point, but can help hugely because it could be you could borrow rather than say, let's say family and friends, let's say even your parents or your sister or brother, let's say rather than them borrowing you can borrow from them and then you can fund that working capital for the company. Is there any questions on that, or is that relatively clear? Okay, I'll take silence as a nod, if that's okay. And I won't talk to you about this right now, but it's something. If it's the other way, at the moment you've got no money in the company, so you would never borrow money anyway. So I'm not going to bring this in, but I just want to raise it. There are the tax rules to be aware of. If you say got an injection of funds into the company and then you borrow that money yourself, so I just want to it's probably best not to do that, but it's very unlikely you do that anyway at the moment in your current stage. Right, so now I come on to the slightly more exciting bit for all entrepreneurs. And if you remember, I talked to you about the government, the UK government. So maybe I just get a show of hands. Does anyone know what Seed Enterprise Investment Scheme is, or EIS is? If anyone can just put their hand up or just message something on the board. Great, Alice. I think you've probably listened to my previous session or you read about it, which is great. Okay, yeah. Great. Oh, someone's unmuted. Oh, Kevin's put a question, hands up. Great. Okay, so it looks like more than half of the group doesn't. But Kevin and Alice, hopefully you learned something new when it comes to this, or reinforce that you should be thinking about this whole area as you decide to invest in, get some equity investment. Okay, so first of all, I just want to highlight that this is basically one of UK's government's greatest gifts to startups and entrepreneurs. And I've been hammering this to previous LSE entrepreneurs and even to LJ. Hopefully she's listening and she's hearing this with one ear as well. Okay, so one of the things I just want, there's two areas for investment relief. One is SEIS and one is EIS. Effectively, SEIS is EIS's baby brother. Everyone in this room who hasn't set up a company yet or has a company less than 2 years old can most likely benefit from SEIS. Companies more than 2 years old will benefit from EIS, but I want you to be aware of both, because you can actually benefit from both even if you're a startup and less than 2 years old, but you can only do this if you're 2 years and younger. Okay, so the main thing you got to remember is that, let's take an example. Alice, are you about to raise money, or is there anyone in this room about to raise any equity at the moment?
Yes, we will be fundraising from March 2021.
Fantastic, that's great to hear. Right, so I'm just going to put some numbers out. So Alice is looking to raise £10,000 for 5% of the business. So, that with a blank sheet of paper, that'll be quite, all of a sudden she's got to go out to market, she's got to get a good marketing proposition, she's got to go out there and really sell her story. But another thing she could consider to help her reinforce the risk involved in investing in any startup business is that she can make sure that her company qualifies for seed enterprise investment. So let's take myself, I'm a UK taxpayer, I'm paying tax to the government, and I want to make an investment into Alice's business. I find her business on the platform for a sustainable business, focusing on sustainable goals, is a great venture, and I see great growth prospects. But I also want to be protected, because what if it doesn't do well? So what happens here is that if I invest £10,000 and she gets the qualification, she gets the certificate from HMRC to say that it's qualifying for Seed Enterprise Investment Scheme and EIS, then if I invest £10,000, I will get 50% back through my tax return from the government in tax paid. So let's say I paid more than £5,000 of tax this tax year, because I put in 10,000 into Alice's company bank account. I will then, after paperwork's received, I will then be able to claim back £5,000 in my tax return. So that's a very useful and very powerful thing. So the numbers, I've just added a note here. So let's say this is Alice's company again. Alice, what was the name of your business again?
GAP 17.
Sorry?
GAP 17.
Oh yeah, that's it, GAP 17. So let's say GAP 17, I've just upped my investment to 100K now because I really like the company and I want to invest more. And so I've invested 100K and I'll get 50K back from my tax return refund. Whereas let's say I was paying 60, 70K of tax, but I only pay 20, 30K now because I'm getting that money directly back. And this is not some sort of aggressive tax planning. This is purely the government saying, I want to help entrepreneurs grow their business. And I want individuals who are UK taxpayers to go out there and find good businesses. So they're basically creating innovation by doing this. And this is one of the reasons why East London is done so well and why the EU are fighting to, well, not anymore now, but the EU are trying to stop this numbers being so high. So I just want to flag that this is a very great income tax relief benefit for any investor into GS17 or any other business that would qualify for this type of investment. And the reason why there's two numbers here, because EIS, as I mentioned, is a slightly more established business. What they're saying is that established businesses have slightly less risk because they've been going on for a bit longer. They've probably got more revenue than business, whereas companies less than 2 years old are very early stage, sadly, more likely to fail. And therefore, the government are willing to underwrite more of the investment that I'm looking to put in. So there's more than one benefit, but that's a key headline that I want everyone to learn and understand and make sure they're aware of, because before you go to VCs, for example, Arthur, a lot of angel investors will come in using EIS, SEIS. They will come up to you and say, or you will go up to them and say, invest in my business, because compared to the other business down the road, I've got my certificate from the government to say that it's qualifying for EIS or Seed Enterprise Investment Scheme. So in another session, I'll talk to you about how you can claim this, but I want to make sure you understand that there is help here. If you've got a great product, let's say you win a few awards or you're on an accelerator and you can promote yourself, then you can also say, no, I've got a great business, but also I can help you get tax relief on that. So Alice has got 100K in her bank account to benefit from the investment. Yes, she's given away some equity, but she's got 100K in her bank. But the investor, myself, for example, I've actually only given away 50K effectively. So that's a very powerful thing where Alice's business will get 100K, but I've actually only given out 50K. The government are underwriting it. So I won't repeat that any further, but hopefully I've drilled that in any more.
And Kevin's got a question just asking, what happens if your SEIS investor gets acquired within 3 years? Do they have to pay back the tax rebate? Asking for a friend, Kevin.
That's a very good and technical question. What happens if your SEIS gets acquired within 3 years? Do they pay back the tax rebate? So what happens is that there is a 3-year sort of window where normally that's a sort of breathing space for companies to just really grow and get on with their growth. And after 3 years, there's other benefits you'll get from here where you get no tax relief. So to answer your question, I believe that there will be a clawback of your income tax relief if there is a sale of the business within 3 years, because what they're also trying to prevent is, I'm sure this is not the case in your case, Kevin, but people will just set up a company, go and raise money from elsewhere, and then close it down or get someone else to acquire it. And therefore, the government has lost out on that 50K because the company's got 100K liquidated or sold up. So this is why this 3-year window is quite important, that there is a bit of clawback on income tax relief or other benefits. So for example, and I'm just going to develop your point, Kevin, so to answer your question, there is possible payback if you do it within 3 years. After 3 years, it's generally okay. But developing your 3-year point is that there are other benefits that you can really enjoy. And one of them is no capital gains tax on sale. So this is a huge benefit for investors. So let's say, again, back to Alice. Oh no, let's use Nukul's example. So Nukul just started his business last month. I really love his business. So I now invest, say, another 10K in his business. And he, after the 4th year, he does so well that LSE, LJ's now has also got a venture fund, and they decided to buy that business or completely take it on board. So they bought it for a huge amount of money, and I then cash out. The beauty is, because I came in with Seed Enterprise Investment Scheme sort of certificate or allocation, there'll be no tax I pay on all the gains, all the cash I receive. So at the moment, the tax rate is 20%, which probably will go up in March. But at the moment, because it qualifies for seed and it's over 3 years old, since I made the investment, I'll be able to benefit from all those proceeds from the sale without paying any tax. So it's a huge benefit. There are other benefits, but I won't in this particular session talk to you about them in detail, but I'm just raising them here to say that investors, if they've just sold a property, they've probably got a lot of cash in their bank, they can actually benefit from further tax relief because they can utilize other things such as EIS deferral and SEIS reinvestment relief on the investment they've made on, say, that SEIS limited company. So it's a bit technical on that, but I just want to flag that there are further benefits such as this and also inheritance tax. So these shares after will become inheritance tax exempt. But again, that's quite technical. And the main benefits that you want to flag to investors is income tax relief. And if your business becomes a great success, you will also not pay any tax. So these are great benefits for you to make sure that when you go out to raise money, Alice, that you think about this as a potential qualification before you go out to your friends and family or to the market. Right. And what's even more amazing, which I find very good, and I've actually used this myself when I've invested in a SEIS company, is sadly, not all businesses do well. And in this room, any business that do so, there may be some that may not sadly work, because the stats show it. But I hope everyone does really well. But sadly, when you look at the numbers, any investment, there is always risk. And the whole point, the government acknowledged that, and as part of their scheme, what they are saying is, when a company does fail and you've held it for more than 3 years, you can actually benefit from further tax relief on your income tax return. So I'll go back to the example that I talked about earlier, where I invested 100K into Alice's business. If you remember, I got 50K back. So therefore, I'm still only 50K net cash position outlay. So my cash outlay is only 50K. So what they're saying is, if I'm a high additional rate taxpayer, so I'm really a high earner, so that net 50K that I had, what they'll say is that we'll times that by 45%, and we'll give you a further 22.7.5K back in the tax return 3 years after you made the investment, because after those 3 years you made the investment, the company failed. So not only have I got my 50K on day one, I get a further 22K.5 thousand pounds back. So my net cost is only my net loss, sorry, on the 100K investment when the business failed is only 27,500. So what I'm trying to say, if everyone can, I know the numbers, we're talking a lot of numbers here. What I'm trying to say is that you can tell any investor that if you're an additional rate taxpayer or higher rate taxpayer, you're basically your only downside risk in investing in me is 27.5p in the pound, because the government are willing to underwrite so much of your investment. So again, this is all very important stuff, so that you're aware when if you have a list of angel investors knocking on your door, you can really educate them, because they should know this anyway, but you can show them that you know the power of SEIS and EIS. And again, the net exposure for EIS is slightly higher, because if you remember, you only get 30% at the initial investment tax relief rather than 50% in the SEIS. So I appreciate there's a lot of numbers here, but the main thing here is that the investor can receive loss relief. So I just wanted to make sure people are getting the headlines here, because that's the main, because you're so early stage in your business. The key point here is that the government is here to help businesses start up and do well. If you've got a good idea, they want investors, taxpayers like myself, to invest in you. So go out to angel investors with your certificate showing that you've got it's called advance assurance. And with your advance assurance, they can go and claim SEIS once they've got their certificate. So I will go into this more detail in the following up sessions. And it'd be worth, LJ, depending on people are willing to get any sort of further feedback, so we can tailor the second and third sessions so that we really are focusing on what people want to hear, because there's so much out there.
Brilliant, yeah.
Yeah, from an accounting and tax perspective, but I'm trying to give you my nuggets of insight, but at the same time, it's also important that you get what you want and the value you receive, and also it will be valid for others as well. So I'll develop this further in the next session, but just in case, for example, Alice, if you're about to do this, say next week or so, you need to go and search for HMRC Advance Assurance. And with that, when you complete that, it's quite a lot of paperwork and form filling, but as long as your trade qualifies, then you can get the advance assurance. With that advance assurance, you can then go to the market or to your friends and family and raise finance using this, and you can forego some of your ownership, equity ownership. And there's various rules, such as you can only give away 30% of the business to one individual. And what you got to remember is that the rules are quite tight on the requirements to invest in this for an investor. So, for example, your parents or your business partner can't invest if they're investing in this. So I won't go into the technicalities of it, but generally, funny enough, if your brother or sister want to invest, it's okay, but not your parents. or your aunties and uncle can, but not your parents. It's just the way the rules are working. But the main thing is that on, let's say, Cedars or Crowdcube, a lot of the businesses on there, you'll probably see a sign, a badge saying SEIS or EIS qualifying, and this is the whole story behind it. Okay. Any questions before I move on? I'm conscious of time. I realize it's already 11:50, so I want to try and wrap up within 5-10 minutes, but I just want to make sure I'm answering any questions. I think there's one by Asif.
Yeah, Asif is just asking about the startup visa and how that links in with the fundraising by the SEIS.
Yeah, I think there are different things. So you, I believe you can, are you talking about getting a visa and then applying, or are you saying? Well, I'll just read the question. Sorry, 1 second on the message board.
Feel free to unmute yourself, Asif.
Oh, I think I understand the question. Those windows are separate. So you're talking about a 2-year startup visa. You're able to come here for 2 years, whereas the 3-year window is more just the fact that me as an investor. So let's say I were to invest in your business, your company. Sorry, just to be clear, your company. I can only claim the no capital gains on sale, or not have to worry about any clawback on my income tax relief if you've held the company has been going for 3 years since my investment. So without being a visa expert, my understanding is that we're talking about 2 separate time periods and time frames. That startup visa point is more about you being able to trade in the UK for 2 years. So the argument is then, if you end up having to leave within 2 years and shutting up, then, and I had invested in you in day one, I may have to claw back if I try to make a claim after 2 years and 1 month. So hopefully that helps you with your point, but they're basically 2 separate things. Okay, so next I want to just flag.
Can I also ask a quick question, Yogesh,
sure,
please?
Sure.
So correct me if I'm wrong, but to be able to get the advance assurance and to be SEIS eligible, you need to have an interest from a potential investor in order to apply. Is that correct?
Yeah.
So I guess my question is, because I've been trying to understand what's the best way to go about this. So because if you start to go to investors without the SEIS badge, they'd be like, I'm sorry, no. Yeah. But if you don't have it, then you can't be eligible, you can apply. So what's your advice on that?
I'll just jump in there because I know exactly where you're coming from. It's a very common question. So sadly, the government sometimes don't get commercial versus they're so busy dealing with tax legislation. Sometimes they don't realize commercially, how can you put a name down of an investor when you haven't gone out to market with your certificate? And it's a very frustrating thing. And we have, the accounting body had been lobbying to say, why have you got this in there? Because you don't know who your investors are until you've gone out there to get them using your certificate. So it's an issue, but I think, there's elements where you have to just write on there when you submit something, you got to see whether you've got some sort of potential interest of any parties, or if there's any indication of any early people they're willing to put them on there. So it's a bit of a grey area, and there's different ways of going around it. So I think you have to sort of put some wording in there to flag how you're going to get your investors if you haven't got any, and just hope that HMRC are willing to accept that. So it's a very frustrating point they have in there, but it's something that it's been written in there which needs to be considered. Okay.
And what about, because I've heard that some people just put like the name of a friend or one of their advisors because it's just an interest, and that person doesn't actually have to invest.
Exactly, and I think that's what I'm trying to allude to, where it's one of those things where people can express an interest, but it doesn't mean that they are definitely going to commit because they haven't seen the full deck, or they find something out which they don't believe in the product anymore. So I think there's an element where if you say do a bit of canvassing initially and then you've got some interest, my valid point is you've got some valid interest, hopefully, which is strong enough to put on that form, and that potentially would be acceptable. So okay, does that I just saw another question? Yeah, great. So great, fantastic. My question, there's a long list. 1 second. There's quite a long email here. I think I'll just I'm not going to read that on this call just yet. I just saw the message. Hopefully LJ can summarize that in a second. I'm just going to move on to R&D tax credit because I'm just conscious of time and I want to make sure this other point is flagged because it's very important that people are aware as they think about their budgeting and funding requirements as they start up their business. So a quick hand, if I may, or any sort of expression of noise. Has anyone heard of R&D tax credits as a sort of policy initiative by the government? Okay, interesting. So first of all, okay, Knuckles has raised his hand, great. So I just want to make sure, again, everyone is clear that as an entrepreneur, I want people to make sure they understand SEIS, EIS in the UK, but also how R&D tax credits can really help you from a cash flow perspective, as and when you develop, when you raise finance and you try to bootstrap and keep your business sustained as you develop. So let's take Alice's example. So she set up a company a year ago. She's about to raise funds and she's developing a platform. This platform has never been built before. It's a brand new platform and it's an advancement in technology. So the concept here is it's a new thing. There is uncertainty and you're creating something which is not really around at the moment. So for example, like the vaccine is a full-on R&D tax development because it hasn't been existed. So I'm just jumping a little bit just to give you a clear example of different types of advancement in uncertainty technology. So the key point here is that as long as you're developing something which is new and uncertain, the government are willing to back innovation. They're willing to fund innovation which is new because they know there's risk in there and they want to help entrepreneurs with this. So what they're saying is that every pound you spend on that, they will give back 33p and 33.3p back. So they do this through an enhancement of 230% of your expenditure in the accounts. But effectively, what they're saying is that, let's say, Alice, so I keep using an example if you don't mind, but let's say you haven't generated an income yet, but you've spent £100,000 on expenditure. So you can claim after your tax return is completed for the accounts, you could claim £33,300 and 24p. I'm just jumping to the slide here. The numbers are slightly different here, but let's say you spend a 50k. Let me just recorrect myself. The tax credit on that would be £16,676. So effectively, what we're doing is you're getting back 33,000 back, right? So I'm jumping a little bit. I'm conscious of time, but I just want to make sure that everyone's aware that they can claim back 33p in every pound they spend every time they qualify for this sort of spending. And what you got to remember is that if Alice gets SEIS funding and they develop a product which is requiring innovation, all of a sudden the government, you can see, is funding so much of an entrepreneur's development and growth in their business. So I just want to make sure people can see that as they develop their product, they should make aware of, read up about R&D tax credits and make sure they consider it when they do their budgeting, when they're preparing their expenses, what is qualifying, what isn't. But again, we can develop this further in other sessions. I think it's important as you start your journey, you know what this is. So I don't want to go into this because this is not very huge. I think we'll come on to that in another session. I want to just summarize a couple of things, again, just to make sure people leave with a few observations. One is, don't forget Alphabet shares if you are setting up a new company. Don't forget directors' loans are not taxable and can be used to bootstrap the business. And if you can't bootstrap and need to raise money, then obviously consider SEIS, EIS, which is very important from a tax relief perspective for the investor. And there are lots of interesting things further I can talk about SEIS. One of them is that directors can invest, and therefore if you just still got employment income and you've just doing this as a side gig, then you can potentially get huge tax relief as long as you've got more than 3 or 4 co-founders who own less than 30%. So again, these are some nuances that can be beneficial for you as an entrepreneur. And finally, the R&D point, given that the IP, if you're investing in something which has got a lot of IP in intellectual property or a lot of innovation and a lot of sort of tech behind it. So let's say the platform for Nakun that he's preparing for his crowd platform, if there's something new out there that hasn't developed, it's very likely that you can benefit from a huge tax refund from HMRC. So I'm going to stop there because I know it's 12 o'clock. LJ, is there anything that we want to bring up as a question?
No, that's I think that's it. I wonder whether I'm just having a look now at the question from Arthur. I think there's probably going to be too much to address now, but I think one of the questions was Section 431 election.
Yeah.
When it has to be signed, I think is the main question there.
I think that's, again, so when we talk about in the future sessions, we're going to talk about EMI, which is employment management incentives, which is share option schemes for management and for key management. So as you develop your business, you will have key employees that you want to really help grow your business, and you'll give them growth shares, you give them shares and or share options, or shares. And Section 431 is in relation to that. So I think it's something, Arthur, I'll probably pick up in the next sections because it's quite technical, or we can pick up on it separately, because I think people on the call may not be sort of ready for that in the stage of their growth. But I think it's something which, when we talk about in context of EMI share options, it'll probably be better understanding for everyone on the call. But happy to sort of pick that up further.
Very quickly, because I know we are at the end of the session, but Nakul wants to know if we can get non-resident individual as shareholders or direct new company registration.
Yeah. I mean, if you're both non-resident director shareholders, creating a bank account is an absolute nightmare, and I heavily do not recommend it. Whereas if you've just got one investor who's abroad and you yourself are UK res and you want to set up a UK bank account, there's no issues. But if you just want to set up a company with you who's UK res and someone else non-res, it's completely fine.
Okay, great. And then Alice very quickly asked, does expense have to have a registered patent associated to it in order to be eligible for R&D tax credits?
No, which is quite handy actually. This is why R&D tax credit is such a great relief, and it's quite easy to get, apart from doing a few reports in the corporation tax return to prevent any sort of challenge by HMRC in the future. R&D tax credits do not need formal patents or intellectual property, trademarks, and legal sort of confirmation. This patent box, which is something you may just want to jot down, is a favorable tax treatment for registered patents, revenue generated products. So let's say you have a car and you've got a new engine in there, and any sales in relation to that engine will get a lower tax rate. But for R&D tax credits, the answer is no.
Great. And then just finally, where should Nakul register? Directly on the government website or through third party?
For what? Sorry.
What's that?
For company incorporation, Yogesh, like there are some certain third-party services which provide a company incorporation, and so I was just wondering, is it like better to go with only the government website for the company incorporation? Or is it like there are certain benefits if I use a business bank account, or I saw like Tide was providing certain services while incorporating the company. So
I mean, it's a good question. I think it's all to do with either or, really. I mean, you can go down directly to the company's house, or you can use sort of a third party. Sometimes, I mean, just like with anyone, where if they're in the business of doing it, they may just provide more added value. So, for example, whether it's one of these online company setup, they may just provide you more guidance. Whereas if you do it on your own, the company house or HMRC, you may miss something which you may have picked up through a third party service, a company provider, or an accountant. So I think it's more that sort of guidance I'd probably suggest.
Thank you. And thank you for all of your questions, guys. That was really great.